Hey guys, I got some really bad news. The seminar that we did today, February 13th, 2020, explaining how to design trading strategies to simplify your trading, is deleted. We weren't on record, it wasn't recording. So here I am. As soon as we finish that seminar, I'm just going to record another one for you guys, going over the exact same stuff that we talked about. And I think this one will be better because it'll be more concise and clear because we're only going to be doing how to build a trading strategy using indicators. So, as you know, there's a lot of indicators, and this function of indicators is to measure specific things on the market. For example, Bollinger Bands are made to measure the breakouts in small time frames. So, for example, it broke out above here and closed, and although it continued up, it's supposed to have a pullback, and it's generally used for uh, just knowing when the market will have a reversal. Here's an example. This candle right here broke out and it reversed. So as soon as it broke out like this all the way up here, this would have been a sell. And as you can see, it continued down. And now let's add on the SMA moving average, which is the standard moving average. The reason it's called standard moving average is because it will measure a few candlesticks in an isolated time frame and then determine what the trend is for that period. So generally they're used for longer time frames, such as 1 hour. So let's go to the 1 hour chart and load up the standard moving average. And this will give you a measure of the trend for that time period. So for example, right here, this candle closed below, so you know that this moving average is telling us that the market's going to sell. And as you can see, the next candle, huge sell. Target 20, stop loss 10. So remember, target 20 points, stop loss 10. So right here, the candle closed at 38.96. You can see close 38.96. So our entry is 38.96. Let's just call it 39. Our entry is 39. If target is 20 points down, then that's at 19. So right around here is our target. I'm sorry, right around here is our target. So on this candle, we would have got that. And let's go to the next time frame. As you can see here, this candle right here, again, closed above. Entry close was at 54. So let's call it entry 54. So then the target's 20 points, which would be up at 74. So did it go? It did. It went up to 74. It went higher. We would have got those 20 points, stop loss 10, and so on. And you just continue doing that for each candle. That one may or may not have got it because on the 1 minute time frame, it may have pulled back. But you would have to write that down and measure what happens with that indicator. Now let's add the EMA, which is the exponential moving average. So similar to the standard moving average, it measures the trend for a certain time period. But with the exponential moving average, it's aggregating, it's taking in all the past data to measure the future results of that trend. So the standard moving average is taking one isolated time frame and measuring that. Generally, that would be the open and the close of the day, because the open and the close of the day, the prices at those points are very important in relation to banks and how markets move on a daily basis. But the EMA is used for the entire period, the exponential moving average. So once you put the EMA and the SMA together, you get a more fine-tuned trend movement. There's even traders that like to only trade inside of the range, not even the outside. So those are two opposites that can exist. One of the questions was, should we be trading with the trend or against the trend? It's a very good question. If you're trading with the trend and your friend is trading against the trend, you will both have the same results on average on a long-term time period, even though you're doing the exact opposite thing. It's just those results will happen at different time periods. Let's go to Excel. So what's happening is that, let's say, for example, John is trading with the trend and Will is trading against the trend. So we add up the trades, 2, 2, -1, -1, 2. These are just the stops and targets we're talking about. We're just keeping it simple to 2, 1, 2, 1 instead of 20, 10, 20, 10. And then you do that for a time period, let's say 1 full year. So John is trading with the trend for 1 full year. Will is trading against the trend for 1 full year. Monday, Tuesday, Wednesday, Thursday, Friday, these are the results. Same thing for Will. Monday, Tuesday, Wednesday, Thursday, Friday, these are the results. Add up those totals. At the end of the year, let's say he ended up with 7 points or $7, and Will ended up with $13, 13 points. Once we visualize that on a chart, it looks like this. So as you can see, the same market movement happened over time in terms of the equity curve, +1, -1, or +2, -1, +2, -1, but at different time periods. Because they isolated a variable on the market using indicators and defined it with a strategy, a set of rules, and that gave them a moving equity curve. Not all equity curves will be positive, most will be negative, because there's many variables you need to take into consideration when building a strategy. One strategy example that we were testing was the MACD. So let's put the MACD on the chart, and you write down your variables. So we wrote down when MACD goes down, wait for the pullback of the candle and sell. That means that once the MACD line, let's remove these. So once the MACD line breaks above its curve, like this right here, then we will be waiting for a pullback and selling. So as you can see here, there was no pullback. So that's a canceled signal. Right here, the MACD line broke down. This broke down right there. As you can see right here, it broke out right here. This is the close of the candle. On the pullback, the next candle pulled back. Remember, that's our rule. When MACD goes down, wait for pullback and sell. So there's the pullback. And next candle, you can see huge sell. And that was your sell trade. Let's go back. Here's next candle. Perfect example again. MACD broke. Remember our rule for the same thing in the reverse for buy. When MACD goes up, wait for pullback and buy. So right here, MACD went up, broke out, pulled back, and then we bought. Right here, this candle, huge profit as well on this one. And you repeat that over and over, and you define specific criteria of rules, and you define them with targets and stops. And you measure that one by one, candle by candle, and you write it down on Excel like this. And then you build a strategy in that format. Targets and stops, in our case, are 20 and 10. So we're aiming for 20 points and a stop loss of 10 points. On volatile days, you will be doing different sizes of trades. So on volatile days, your target may be 40 and stop 20. A less volatile day, 30 and 10, or an average day, 15 and 10. So target 30, target 15, target 40, depending on the volatility of the day. How do you measure volatility? You would have to manually see that during the day. For example, imagine your isolated time frame begins at 4 p.m. You would see if the past few hours, let's go to 1 hour, was volatile. Volatile means tons of movement. And as you can see, for the past few hours, it was not volatile. It was volatile over here, but it's already done. If you were on this volatility at that time, then you'd be like, wow, this day is moving like crazy. That means my target and stops will be larger. Because you need to match the volume in order to not get stopped out and actually capture the volume or the points in the market. But right now, as you can see at 4 p.m., there wasn't that much volume. It's generally stagnant. So you would apply the lowest one, which is 20 and 10. In this case, we just wrote 15 and 10, whatever. Let's just change it to 20 and 10. And yeah, so that's why we stick to 20 and 10. The reason for that, as we just explained, is because we know that every day will move at least 20 points. Like, not even every day, every half hour, it will move 20 points. Like, it's crazy. So once you isolate the market into those variables, you can determine your entries and exits. Now, that goes back to the question of how do you define a strategy? Every strategy works. Instead of MACD doing these rules, we could have reversed those rules and done the exact opposite and ended up with totally different results happening at different times, but the same frozen, static, consistent movement of equity. Now, it wouldn't be necessarily up. It wouldn't even be down. There's companies that even break even the whole year and still make profit because they're collecting tons of fees. We covered that in the other video, but there's hundreds, millions of strategies that you can create. That's why you see in regulated portfolios at the bank, there's like uh, the star the Star Galactic portfolio, or like the Delta Arrow strategy, and it did like 2%, 3%, 2%, 3%, exactly like this build up that they or that we did an example of. Um, so yeah, once you understand that you can make a strategy out of tons of rules and different types of indicators and things that you align up on the charts, as long as you have your targets and stops in place, you will be on the right path to creating a consistently moving portfolio strategy and testing that every day and doing it manually, understanding market dynamics, and all those other things play a factor in getting fast at doing it. Um, Now, when I started, it was very difficult. Like, I know, like, maybe you're thinking, like, oh, this is so petty and tedious to have to write this down and stuff like that, and it's going to take so long. Like, just even remembering, like, my strategy is when MACD goes down, wait for pullback and sell. All these things may feel slow at first. It did for me. Like, the first few weeks, it would take me like an hour to, like, even, like, wrap my head around remembering this stuff. But so after a while, you become lightning fast at it, and you'll feel grateful that that happened to you, because it'll really make you on point with your accountability of your finances as well as every other aspect in your life. I don't mean to be going into the philosophy side of things. I'm trying to keep it as straightforward and technical as possible, but it will happen as a side effect that because you are invested into the market and experiencing these movements and taking note of them, like plus 20, minus 10. My entry was 23, my exit's 43. My entry was 72, my exit's 52. You'll just become very fast at it, and it'll be a very positive attribute that you can add to your existence, or whatever you want to call it. But it will help you greatly. Even if it's not directly in investing, it will have a positive effect. Just being involved in the market will literally carve you out and convert you. So don't be scared. Start as small as possible and follow the rules every day. Yeah, so hopefully that simplified things on how to make a strategy. To keep it simple, you would take your indicator onto the chart and you define your variables, and using those exact ranges per trade, you'd record it one by one and start entering and exiting based off those criteria, and create a filtration system with a few indicators on the chart to best know how to enter and exit the market every day. On our login trade room, we have the range bars working 24/7, which is just a simplified way of understanding the trend. Because on minute based bars, the trends are random. Of course, you can quantify them on minute based bars, but we cleaned it up on the server here and kept them in finite ranges that are the exact same every time. What that gives us is a clean view of the market. So by using filtration systems such as these, it makes it much easier to understand how to extract small gains out of the market and consistently keep yourself safe. Remember, profit is a side effect of safety. It's not that you're looking for money, it's that you're looking to stay safe while consistently keeping your portfolio stable over time. So having strict systems on how to filter trades, as well as a strategy on how to enter and exit with exact ranges in place. Again, remember, we wrote it down on Excel. An example is when MACD goes down, wait for pullback and sell. And you build in tons of filtration systems like this into your system. Then you have a way of safely entering and exiting the market daily. The signals that we have running here are running 24/7 using exact ranges, as well as many indicate, like literally hundreds of indicators. We sat down with a team of 10 developers and we all wrote it down one by one on Excel like this. And we did it manually, step by step, and actually went through years and years of data to come to the conclusion of this being the format to trade in, multiplied by all the indicators and rules that required all the coders to be together and doing it together, because there's so many rules that went into making it say buy or sell. So it's the same thing with you building your own strategy, because you want to have this skill for yourself and understand the industry. It's the same thing. You take the indicators onto the chart, you define a set of rules.
Get ready for a sell, BTC/USD.
You write down those rules, you define the ranges, and then you trade one by one and actually tally it up and figure out the results. And you'll find some very solid discoveries by doing that. So our room is there for you to use for free. If you have any questions and you require assistance setting up, just let me know. And yeah. Oh, no. So this setup that we have here is not a simple setup.
Get ready for a sell, BTC/USD.
The question was, why can't we just download it like a normal indicator? It's not a normal indicator. We actually had to get all these premium data services and charting systems in order to make this work, because on existing normal data, they're using a lot of middlemen, so there's a lot of spread. So that makes the coding itself impossible, because when we're using normal data, we needed these candlesticks running like this, but with normal data, they're very spaced out. So a candle will be here, next one will be like over here, didn't account for any of this, and so on. So in order to do that, we literally had to pay upwards of $5,000. The total was around $8,500. If you want to be in contact with those coders, we can put you in contact with them. As we can show you the invoices and everything if you need. But this is not a basic setup. We just made it look very simple on the front end. It takes a lot of development. So if you're looking to just get these for yourself, it's going to cost a lot. Just a heads up if you want to contact them. But no, you cannot just download this and have it running. To even stream this from the NinjaTrader platform onto MetaTrader and then funnel that into the correct data is this whole like 3-week process. So yeah, it's important to just understand what you're doing. So that way, if one day you want to build your own strategies, indicators, tools, systems, you understand how to do that, which is by taking the indicators, aggregating a set of rules. Aggregate just means put together, combine, and then tallying it up one by one. And that's how you stay safe in the markets. Hopefully this helped you in simplifying how to build a trading strategy and the importance of indicators, staying safe, and how to navigate through the markets long term. And if you have any questions, let us know. I'll get back to you right away. We're here for you guys 24 hours a day. Remember, there's no charge to use the room. There's no charge for our services, nothing. We just ask that you just follow the rules, pay attention, and just really invest your time in understanding these skills. Have a good day, everyone. Good evening, and goodbye.